Welcome to Choosing Your Investment Philosophy. This program that I'm going to show you, this slideshow, is one that had a major impact on my life. Because about 30 plus years ago, I'm not going to tell you exactly, but I went to work with a company called A.L. Williams, which was an insurance company that was buy term and invest the difference. And Art Williams had just started this thing up, and it was a multi-level marketing concept. And I went to work with that because I wanted to help clients. I wanted to help people save money on their insurance, get better coverage, and have money to put aside as to invest the difference. Well, that was years ago. And the biggest question I had when we finally got into investing the difference was, how do I know that the investment that I'm recommending or showing people is going to perform the way it's expected to? The way that I'm telling them, oh, this is a good product. This is what you need to do. At that time, it was mostly retail mutual funds. Templeton, AIM, Weingarten. There was a number of them, and they were all retail. And I had never seen what I'm going to show you tonight. Okay, so I've been on both sides of the equation. And we really have to choose our investment philosophy. Have you ever worried about getting high enough returns on your investments? If you have, check the box. Have you ever worried about maintaining your standard of living at retirement? Now, we're all in different stages. Some of us are in the accumulation stage, some of us are in the preservation stage, some of us are in the income stage where we're pulling income out of our portfolios. The underlying philosophy is the same, all right? Well, what you're going to see, it fits everyone that's in the market, okay? Have you ever worried about affording a high-quality education for your children if you're in the accumulation phase? Am I going to have enough money in 10, 15 years for my child to be able to pay for a college education that he or she deserves, or that I feel that they deserve? If so, put a check mark there if that has been a concern. Have you ever worried about the next market crash? We had the one in 2008. We had the one back in the early 2000s. We had the one back in 1973. And we've had mild upturns and downturns during the years in between, from 73 on. Have you ever worried about the next market boom? Would you say right now we're in a market boom? Okay. Now the fear can be, is it going to last? Is it going to go down? What's going to happen? Okay. If that's a concern, check the box. How about missing out on the latest, greatest stock tip? Okay. You ever think about that? How about making sense of all the information that's available out there? If you put in the word stock in the internet, you'll come up with over 200 million pages. Okay? How are you going to gather all that information? How about someone else having a better portfolio? Gather around the water cooler and you hear, oh man, I got 16% off my portfolio last year, and yours only did 8%. Or the fund they're in outperformed everything. So what do? You think about, well, maybe I need to move to that fund. Okay. How about not having enough money to care for loved ones? One of the concerns that you may have is, well, I have enough money in retirement if something happens to me that my loved one, my spouse, can continue on. How about getting bad advice and paying for that bad advice? Okay. How often does that happen? Are you worried about that? How about buying high and selling low? How do you make money in the stock market? One way. You buy low and sell high. Many people, they come up with this: buy high and sell low. What we have is what we call the investor's dilemma. A lot of times people have a concern or fear about the future. What's going to happen going forward? Well, we just checked. How many people checked any of the boxes on Okay? Oh, we got it. Good. Okay? Concerns, and they're legitimate. And what do we have? What does that mean? Well, we've got a fear of the future, or a concern about the future. What's going to happen? Am I going to be able to have the money that I need? So what do? We look for someone to give us kind of a forecast or a prediction. I can't tell you how often I hear, what's a good stock to pick? What's a good mutual fund? All right? And how do you find that stock or that mutual fund, that manager? What do you look at? Past performance of the manager, right? Go to Morningstar. Look at all the information you can find on the internet of how well that particular mutual fund may have done. So we look at it at the track record investment. Then what we do is we try and get as much information as we can in order to make a decision about that. And with all the information out there, the millions of pages or the differences of opinion we have out there, we wind up with information overload. Which thing do I pick? Because everything that you look at, you're going to find somebody on one side and somebody else on the other. Okay? Whenever you sell a stock, in order to sell that stock, what has to happen? Somebody has to buy it. Now, the person that's buying it, if you're selling it, do they believe that that stock is not worthwhile? No. So, which one's right? Only time will tell. So, we wind up with an information overload. And when we get into an information overload, we wind up with what? We make emotional-based decisions. Okay? We rely on our emotions rather than doing wise investing. And then we break the rules of investing. Market goes down such as it did in 2008. What were people doing in 2008, the beginning of 2009? Selling. Were they selling high or selling low? They're selling at the wrong time. The thing is when you do that and you make that market decision, you have to be right twice. If you move to cash, what do you have to do? You've got to be right when you move back into the market. So you have to be right twice. Very few people are right twice, let alone 3 times predicting the next market drop. So breaking the rules of investing, there's 3 main rules. The first one is own equities. The second one is diversify. And the third one is to rebalance. What happens when you move from equities to cash and get out of the market? You've broken all 3 rules. 1, you got out of equities. Number 2, you didn't diversify because now you're all in cash. And number 3, you can't rebalance because you've only got one asset category in your portfolio, cash. So then what happens is when the market turns around and starts back up, what are you looking at? Performance losses. And you see, well, the market's starting to move up. Is it going to stay moving up or is it going to drop again? So you hesitate on getting back in. And then it keeps going back up. And it keeps going up. You think, man, is this going to continue? And what happens to your portfolio? You're sitting there and you're seeing all these people that are making money, and you're looking at performance losses from the standpoint that you're not making what other people are, and now you're back to the start again, the fear and concern about the future. Okay? Anybody been in that dilemma or felt that way as far as what do I do and made emotional-based decisions? I have. I've been there, and I've been an advisor for over 30 years. And this was what I was in, both as an advisor as well as a investor. Not enough money and no peace of mind, okay? And that's what we want to give you, is some peace of mind.